So we'll take S1 and S2 as our spot rates. And as I mentioned yesterday, let's say I want to calculate F11, which was my 1 year forward rate 1 year from today. And we have these two rates which are given, then we can easily imply F11. So so a simple timeline which we had seen the other day. So we have a S1 here, we have the S2 here. So that way I can imply F11. So basically using this simple relationship, we'll adjust the rates for as required by the compounding frequency, etc. But for now, we can just keep a simple representation. So something like this. We have S2, we have S1. Now all that is required is F11. So it's a very easy equation to solve. Only thing is we'll make it recursive. That is something similar to spot rates. We'll try to have a forward rates calculator so that in one shot we get the entire series of forward rates for our consumption. So that is something which we'll try now. So can I request you guys to open your Excel spreadsheet? So either you can use the same sheet as yesterday, or maybe just open up a new sheet and we'll copy the rates directly. So I'll continue to use the same one as I did yesterday. It will be easy for me to copy the rates and use it there. But you're free to either switch to a new sheet or maybe continue with the same one. So is the idea clear as to what we are trying to accomplish? Any questions on this? So once we do this, you'll be very comfortable to handle any of floating rate products. So once this idea is clear, you can apply it for a variety of things, maybe a forward rate agreement or maybe a floating rate note or even a swap. So does the idea sound okay? Can we try to have a function for F11? So when I say F11, you can imagine generically forward rates at any point in time in the future.
Yes, sir.
Yeah. Okay, so let me open the same Excel which I did yesterday. Okay, my Excel is open, so I can just share screen. Okay. So this was my file yesterday. So let me copy a few things. These two I can copy, paste here. I will also require the spot rates which I've calculated. So I'll just value paste them because these are formula driven, so it will throw an error otherwise. Okay. And now I have the forward rates which I want to calculate. So imagine that this is a blank which I'm trying to fill. So, and let's say these two things are given to us. So you guys can also do the same thing. Maybe just copy your TTMs and spot rates. So spot rates will have to be value pasted. If you paste it via formula, it will throw an error. So request you to do I think it's RTSV, or maybe just do the value pasting thing and then we can begin. So once everyone reaches here, let me know, then we can start. So this was spot, and this is implied forward. So both of these can be like useful calculator later on also, because there are good chances that you may have to work on floating rate products at a certain point in time. So that way, having an idea of this logic will be useful. can we proceed? Should we try to develop a new module now?
Yes, sir.
Okay, so I'll also just go to the developer tab and Visual Basic. I think I'll need to just switch my screen because I think the screen sharing won't switch automatically. So let me switch to the VBA screen. Okay, so this was the one which we did yesterday. So I'll insert a new module. So insert module. So I have a second module now. So this will be like a fresh thing which I'll do. Let's keep the two things separate so that we have two separate calculators whenever required. Now, again, we are going to define a user-defined function or a UDF because that way we can call that function in other sheets also. So maybe we can simply export this to a separate Excel and use them directly. So it can so happen that one functionality which you develop in one Excel can be used somewhere else as well. So that way UDFs come very, very handy. So let's do a function implied forward rates. Again, here I'm going to pass the array on the right, which I've shown. So the numbers 1 through to 6, which are nothing but my time periods, which I've named. Then I have my time to maturity, and I have the spot rates. So now I have three rows, which will go in as my inputs. I can call them as maybe spot rates or something like the last time. So we'll pass it by reference. I can say spot rates as now my input is a range, right? It's a range of rows and columns. And I'll leave it as variant. So I'll leave it to Excel to decide which data type it feels is appropriate and use it directly. Now, variant is something which you should use carefully because many a times it can so happen that variant may give you an unstable solution. So if that happens, you should try something more specific. So something more specific could be you can decide on a data type which is other than variant, maybe a double or an integer or something like that. But for now, we can leave it as variant. If this runs into problems, we'll try some other data type because that way Excel or VBA is not very intelligent when it comes to handling of data types. So at times it can make mistakes. So if a variant thing doesn't work, if you get an error, maybe we can try some other return data type. But until then, this should be fine. Now, just like last time, we'll define our dimensions, or I'll define my number of rows and columns because I want to keep it dynamic. So I can have dim n rows as integer, something similar to last time, dim n columns as integer. Now I can count the number of rows and columns as we did the last time. So approach won't be very different. I'm just doing it again because that way you'll also get the practice of doing things. Otherwise, we could just copy some things from the previous code and use it here. So in our actual project parallels, yes, you'll definitely do that. But since we are learning these things newly, I am rebuilding the model once again so that if a certain concept which was not clear yesterday, that gets cleared today. So I can do spot rates, what rows dot count. Also count my number of columns like I did yesterday. I have spot rates dot columns dot count. So this should count my number of rows and number of columns like I did yesterday. Now again, like last time, I would like to have one intermediate array to hold things because again, that's more of a habit which has developed over time, but something which I feel comfortable rather than using the data directly in my main calculator. I prefer to have a buffer layer in between and then I use it. So following a similar approach. So I can create an array. So I can have dim. Firstly, I just create C as double. So this will be my main array which I'll use. I need to redimensionalize this like I did the last time because I want to keep the array dynamic, right? So I need to use the number of rows and columns which I'm plugging in. So my dimensions will be 1, 2, n rows, comma, 1, 2, n columns, exactly like yesterday. Now, I can also define my C input thing, which I'll be using, right? So I can have dim C input, which is my intermediate or buffer array as I call it. I can keep it as variant. So I just allow Excel to decide how exactly it wants to handle it. And I can say C input as it will be my spot rates dot value. Once everyone reaches here, let me know. And also any questions up till now, you can ask them as well. So that way the logic is similar up till now, whatever we have done yesterday. We haven't reached the implied forwards yet, but we will get to that in a bit. So do you guys have business valuation as a part of your curriculum also? So do you guys have free cash flow models which are covered? And do you guys do that in Excel?
So free cash flow valuation using discounting factor.
Correct. Yeah. DCF valuation. Correct.
Yeah, we did some preliminary. Sir, Ali was trying to say something about it, I guess.
Oh, sorry. Yeah. Please, Ali, go ahead.
Same thing, sir. Same thing.
Okay. Okay. Because at that time you get extensive use of Excel, because most of the times for financial modeling exercises, Excel happens to be like the most chosen tool, especially whenever you have to build any kind of estimations on forecasts of your financial statements, so your income statements, balance sheets, etc. So that's where plain Excel gets used. But even at that time, VBA is something which can come handy, because many a times certain calculations, if they get messy in Excel, then maybe a VBA can be an easier and a cleaner way to do it. And I would say more flexible up to some extent. So has everyone reached this point? Can we proceed?
Yes, sir.
Okay. Now let's define I and J as two things, because I want to populate my array C. So I comma J as integer, because I and J are counters. They can definitely be integers. Then I have a for loop. So for I in I, so I equal to, sorry. So I was actually doing some Python coding in the morning, so I thought I in range, but that won't work here, isn't it? So for I equal to 1 to n rows. So by default, most of the things happen row-wise. So that's a default operation which we do. So if you have to traverse through a table, we always do things row-wise. I have rarely seen any circumstance where you have actually done the calculation column-wise. Because if you can imagine of, let's say you have a portfolio-wise information given to you. So that way you have trade-wise data given. So every trade will have, let's say, 10 columns, which are specific to that trade. So we start things trade-wise. So in the normal business as usual scenario, you'll always do things row-wise. So your outer for loop will always refer to rows, and inner for loop can refer to columns. Because you start with one row, you handle all the columns. Then you go to the next row, which is your next trade, and handle all the columns, etc. So something similar we are doing here as well. Of course, now there is no restriction that you can't switch column-wise, but I don't really know if there are specific applications to that. And do a Cij equal to C input ij, and I have a next j, and I have a next I. So similar to what we did yesterday, this is going to populate my array C, which I can subsequently handle. Now we can begin some implied forward calculations. Save the file once. Okay. Now here I can have dim forward as double. I can also have a result array which I'm creating. So dim result as double. And I'll do a redim as well because I want an array like yesterday. So the idea is I'm going to devise that function in such a way that if I pass those first three rows as inputs, which is my uh, time counter which I've put in 1 through to 6, then the time to maturity and spot rates. If I give that much, that one single function should be able to populate my forward rates for me. So that is what I'm planning to hold inside the results array. So read him result. So it will be just one row, but there will be multiple columns. So 1 to n columns. Okay. Here I will require S1 and S2 because I would like to either S1 or S2 or Z1, Z2, whichever you like. I'll just keep it as S1 because S is for spot. So just S1. So S1 comma S2 as double. Okay. I have a forward. I have the result. I have S1, S2. I'll require a counter as well. So to switch in counter as this can be a, so I can keep that as double as well. Okay. Else which I feel. So counter will help me. I think maybe I'll require a temporary index, maybe. Because I have two separate powers to be handled, right? So maybe counter can help me handle something like 1 plus S2 square, and I have 1 plus S1 raised to 1. So maybe something like a temporary index, possibly. Let's see. If not required, we can just ignore this later. Okay. Forward is there. Okay, this looks fine up till now. If we require something else, we'll see. So everyone with me up till this point?
Yes, sir.
Okay. So my question will be for the very first period, will I have any forward rate or what would be the treatment? So that way, if you see in your respective Excels, which we have created a small table. So in my first period, which is time to maturity of 6 months and the spot rate is 0.03, what would be the value for forward rate there? So in that very first column, what do you expect? What should be the forward? So I'll just switch if you like. Now, it's this which I would like to know. So in this cell, what would be my rate? Now here you don't really need a, so I'll give you a hint. You don't need a calculator for this. So what should come in this cell in blue? And do I get something or do I not get anything? So do I have any period prior to this or is this my starting point? Do I have anything before this?
So you have a 6-month period before this, right?
But this, so I'm standing on the 6 months. So imagine this is my first
Oh,
data
okay,
point
okay.
available. So I
Okay.
don't have anything prior to this, right? So can I have a forward rate here or not really?
I'm not sure, sir. I'm a bit confused, to be honest.
Okay. So there won't be any forward rate because we don't have any reference prior to this. This is my starting point. So imagine this is like my first data point available. Prior to this, I don't have any information. So in the very first cell here, I can't really have anything. Now, if I want, I can simply equate this as 0.03, but that doesn't make any sense because I don't have two periods to compare. This is my very first period. So my actual rate calculation should begin from this remaining part. We'll develop a function in such a way that once we select this, the first block can either remain blank or zero. Because for the very first period, we don't have a forward rate because the concept of forward rate won't exist for the very first period. But going ahead, yes, definitely we'll have forward rates. So does that make sense?
Yes, sir, got it.
Okay. So let's go back. So that way, maybe we can keep this as a 0. So again, I can have two conditions. So two if conditions. So one if condition will be for the very first period, whereby I don't really need to do any calculation. But after that, after my first period is done, implied forward calculation should begin. So something similar to like we did yesterday, we can have two conditional statements. So let's try that. Okay, so this is given. Do I need anything else? Not really. So forward rates are there to handle things. Not really. So for, so maybe let me do a space here. So for j equal to 1 to number of columns. Okay. Now I can have my first if condition. So if j is equal to 1, that is if I am on the very first column, that basically implies I am on the very first period. If this is the case, then do something. Let me hit a few enters so that this thing comes to the top. So if it's the very first period, do nothing. In my result array, I can just leave it as blank, but blank would look slightly weird. So maybe let's put it as 0. 0 or blank, both doesn't matter, but visually maybe 0 may look nice. Once we do that, I want to increment my counter by 1 because I'm moving a period ahead. So I think there is another way. So there is an in-place addition. I'm not sure if I don't recollect if it works in VBA, but we can try that. So plus equal to 1. Okay, so I think it doesn't. Because in Python, it works this way. This is what we call as the in-place addition. So when I want to do counter equal to counter plus 1, this is something which works in Python, but I don't think VBA is accepting it. Or is it equal to plus 1? I don't think so. It's that way. No. We might as well write it counter plus 1. But that in-place addition becomes easy to write. So it basically saves on your typing effort. You can do just counter plus equal to 1. That is equal to, so that basically implies counter equal to counter plus 1. But unfortunately, it's not accepting that in VBA, which is fine. Okay, so my first if can get done here. Now, the next if is basically my implied forward calculation, because once my first period is taken care of, in all of my future periods, I'm going to definitely have some forward rate. So I have a if j is greater than 1, that is once I go a step ahead, then do a few things. So is it clear as to why I'm splitting this into two conditional statements? Does anyone have any question as to why these two if conditions exist? So what's the benefit of doing it this way?
So which line are you referring to?
So the first if condition which I've written, this, and I'm writing a next if condition. So is it clear to everyone why I have split it up this way?
So to prevent negative rate from going in.
Not really negative. The only thing is, for my very first period, I don't need an implied forward calculation. So that's what is happening here. So that's why I'm plugging in result equal to 0. Because for the very first period, there is no forward rate to be calculated. So I can either leave it as blank or maybe I can populate that as a 0. So my very first period, so the one which I had highlighted in blue in my sheet just now. So that is something which my first if condition handles. Now, once I do j greater than 1, that basically implies that I have come to period 2, or I am maybe on column 2. And from that column onwards, I have a forward rate which will get calculated. So now inside this second if, I am going to write my implied forwards logic. So is that okay? Okay. Okay, so once I go a step ahead, I need to use that implied forwards formula, which I've done. So I can have my S1 equal to, so where is my spot rate? Spot rate is in 1, 2, and 3. Okay, so it will be 1 plus and 1, 2, and 3, right? So I have 3, comma, the counter variable. Okay, I have kept it as semi-annual, so that's why I'm dividing this by 2. Okay, and this will be raised to, I need raised to 1, right? So let me write temp index. I'll set temp index to 1 and use it. Because I have 2 separate powers to be used, so that's why I have introduced temp index. I think there's one extra bracket, is it? Extra bracket. Before that, let me just set temp index equal to 1. So you can imagine this is just like the 1 plus S1 raised to 1, which I'm trying to handle. So that's what I'm trying to represent through S1. Now I'll increment temp index because I have S1 and S2 which I'm working with, right? So I need one step ahead. Now I have temp index which is set as 1. I can increment the temp index by 1 and I can use the same temp index for handling my second period because I need something like 1 plus S2 square, right? So for that, maybe I can use temp index. I can do a temp index equal to temp index plus 1. Okay, so that basically makes temp index equal to 2. And then I have S2 equal to 1 plus, again, I need my spot rate. So 3 comma counter. Now it won't be just counter because I need the next period, right? So plus 1, sorry, plus 1 upon 2 raised to, now I can just have the temp index because that has also got incremented. Okay, so 1 plus S1 raised to 1, 1 plus S2 square because it's counter plus 1. Yeah, this looks okay. Let's see. Now I can write a simple equation for forward. So imagine that I'm solving for that F11, which is there on the right hand side. So I can say that I have S2 upon S1 minus 1 because it's 1 plus S2 equal to 1 plus S1 into 1 plus F11. So on the right hand side, since I want only F11, I can move the 1 to the left hand side as well. So simply rearranging that exact same equation written on the whiteboard, I can write forward equal to S2 upon S1, okay, minus 1. And again, this will have to be multiplied by 2 because it's semi-annual thing. I can say result of J, because J has got incremented. This will be equal to forward. I will increment the counter by 1 because I need to move ahead in time, right? So counter plus 1. Okay, so S1 is taken care of, S2 is taken care of. I've plugged them in together. Forward is calculated, forward is moved into the result array. Now I can just reset S1 and S2 because on my next run, I want S1 equal to 0, S2 equal to 0. Now again, this is just a safeguard. Now these lines may not be required, these couple of lines, but the thing is whenever I'm using that variable recursively over and over again, it may be a good idea to reset them to 0. So something like we did the last time. Now in the last time it was required because my DCF was like a running counter. Now here S1 and S2 are not really a running counter, isn't it? Because I'm calculating S1 and S2 separately every time. But I just want to make sure that the previous values are completely wiped out and I have a fresh S1 and S2 coming in. That's why I'm deliberately resetting them to 0. I could have left it that way itself. They would have got overwritten. But I just want to avoid that any potential chances of mistakes. So that's why I've done it this way. I'll also like my forward to be set to 0 just to be on a safer side. Forward will also get overwritten, I know, but if it doesn't, I'll get junk values. So is everyone familiar with the idea of garbage values or junk values inside a variable? And why do you reset numbers to 0?
So could you please explain that?
Yeah. So the idea is whenever you are creating a variable, so basically what you do is you're trying to give a name to a certain memory location inside your computer's memory. So inside your RAM, which we call it the random access memory, you try to allocate a certain memory location for that variable. And many a times there will be junk values or garbage values as we call sitting inside those memory locations. So unless they're overwritten, those values will continue to remain. So as a part of normal code action, they will get overwritten like S1, S2, they will get updated automatically. But in case if something happens and S1 and S2 doesn't get updated, and if those garbage values remain and my calculations keep on getting impacted by them, then it becomes very difficult to figure out as to why a calculator is behaving weirdly. Because maybe the entire logic could be correct, but owing to garbage values, I'm getting some arbit numbers which are simply difficult to decode. So to avoid wastage of time in those kind of efforts, we generally reset things to zero, especially in these circumstances, and then we proceed ahead, so that any problems of garbage values are taken care of. And if I need a next J, what's the name of my function? I just scroll up a bit. IMPFWD, I and F capital. Okay, this will be equal to my result. I think we are set. So let me I'm just setting a few backspaces so that that end function comes above. Okay. This looks fine. Maybe we can quickly do a debug if required. Once everyone completes this, let me know. Then we'll write a small sub procedure to debug things before we run it entirely. I'll just save my file till then. I may also think of setting counter equal to 0 just to be on a safer side. Okay. Maybe even the forward which I'm doing, FWD, I can just reset to 0 before I use it for the very first time. So just putting a few additional checks so that erratic values do not flow in. So until you guys complete, I'll just go through the logic once. Maybe I could just have one bracket here. So generally BoardMass works correctly, but I'll just add a couple of additional brackets. They may or may not be required, but I personally will be more comfortable adding them. Okay. Whenever I generally have doubts about the flow of a certain equation, I generally add brackets because brackets ensure that your calculations happen correctly. Even if there are more brackets, it doesn't matter. As long as you're sure as to what is happening, that's good enough. Okay. Otherwise, this looks fine. So once everyone reaches this end function, let me know. Then we'll try a simple debug. So that way, if you see, this is a very less coding effort. We have already done the hard work yesterday, the spot rates thing. Now this is just one step ahead. But again, we have a small model ready with us for implied forwards now. So in the meantime, let me just add a sub procedure. I would like to quickly step through if the logic works fine. So maybe sub test forward. Okay, and I can have a dim output as a range, and I can have the out output. So output equal to time PWD. And let me just pass a range. So I'll just hard code a range for now, just for testing purposes. Let me just see what range of cells are going to go in. I can do a K1. I can maybe do a K1 up till, let's say, N, K1 to N4, N, yeah, N3. K1 to N3 can go as an input. Okay. K1 to N. So let me just put a breakpoint here. And I just open these lower windows. Where have they vanished? Locals window, which was there yesterday. Okay. Just minimize this. I've already set a breakpoint below. Now let me set one breakpoint. Anyways, this program flow will happen. So let me just start debugging. I have a breakpoint. Somehow not going into debug mode. K1 to N3 is the correct one. Right? So K1, N3. This is fine. So what's the problem? Why isn't it going? So maybe I keep it here and yeah, okay. Okay, so counting number of rows and number of columns, let's forward them. So 3 rows and 4 columns. I can just bring this up as well as we step through. I'm just doing a function f8 just to see if my program flow is happening. So this is something which I can do quickly to see if array C. Now let's see how array C looks. Okay, so I'll have these time points 1 through to 4. I'll have time to maturity 6 months, 1 year, 1.5 year, and 2 year. Okay, and the spot rates good. So inputs have come in correctly. Now the very first period result will be 0. For the next increment, it should go to the second if, which it has. So my result array, let's see how does this look. So let's just complete this run and see how result array looks. Now let's see if my forward is getting populated. So good, yeah. So it is populating forwards. Let me just do one more run to see if it's getting updated. Yeah, it does. All right. So maybe let's try running this now. This looks fine on the face of it. I just remove the breakpoints. I'll also just comment out the sub procedure. So just for testing, I'll just remove the breakpoint at the top. Okay. Now let me go back to my Excel. I think I'll need to just switch my screen again. Go to Excel and then let's try to run this. Okay, so I'll select the entire range. I do equal to implied forward. this entire chunk can go in. So, okay, this looks okay. Later on, you can check the calculations. The calculations will more or less tally because we have just implemented one simple equation. So that way, my very first thing remains 0. I could have kept it as blank. So those of you who don't want 0, you can simply have that open and closing quotes, which you can have in your first if conditional statement. So we have two ifs, right? In the first if, I have plugged in a 0 manually. If you don't like 0, just have a double quote, double opening and a closing quote, and leave it that way. So that way, it should populate a 0. Or so it should populate a blank. Otherwise, 0 is also fine. So request you to try this if you're getting the required output. So now you guys have become experts in fixed income. You know bootstrapping, you can also calculate forwards. So in your respective roles, you can tell your boss that you know all this stuff and you can learn something more advanced. So once everyone gets this, we can proceed. So are we good? Can we proceed?
Yes, sir.
Okay. So let me just open up something. I think just one small portion of the FRA discussion was remaining. I'll just quickly complete that and then we can start something new. So let me just switch to that presentation. I think just one or two slides to go. I think it's done. Yeah, we completed the entire thing the last time. All right. So FRAs is taken care of. We'll discuss maybe interstate options today, or maybe yeah. I think options should be. So now I give you guys a choice. Do you guys want to study interstate options today, or do you guys want to talk about bank capital adequacy, etc.?
So whatever is a bit lighter, I feel. It's
Okay.
getting late also. Whatever you feel is light.
Correct. Then I think capital adequacy would be better because interstate options are something which will require some additional discussion. So possibly we can park that for the next week. But we can definitely start with the capital adequacy bit. So I'm sure some of you may be aware of a few things because if you guys have covered some bits of capital adequacy or maybe Basel guidelines, etc., as a part of your course, then this might have been covered. So in that case, it will be some parts may be a revision, others may be new. So have you guys done anything on these capital requirements for banks? Or was it covered in any other subject?
So we had it as an optional. Not sure how many actually took it now. I know it because I've taken it.
Okay, okay. Because actually it's a very important topic because finally, yes, I mean, all of these quantitative models and fancy analytics, etc., it's all good. But for any bank to function, having a robust capital framework is very, very important. So without that, a bank cannot survive. So for that, and this capital charge, or I mean things around adjustments for illiquidity, or maybe how exactly do you use behavioral modeling in your analysis, etc. That is something which gets used often. So that's why having an idea of the capital framework is very, very important. So that's also in line with your three pillars, which are given as a part of the Basel capital adequacy. So the Basel III circular, which I had mentioned the last time. So most of these things are borrowed from there. So talking a bit on the capital requirement side of things. So before we actually talk about capital, why do you think that a bank requires capital? What could be the main reasons behind these?
Sir, it can act as a cushion when the economy goes down, basically.
Okay. Acts as a cushion or a safeguard. Okay, correct.
Mhm.
Sorry, it's a spelling mistake, but imagine this. The spelling is correct. So cushion or a safeguard. Because I think here I can't really erase this. So imagine that the spelling is correct. My apologies. Anything else as to why a bank may require capital? So can I say from there, from pursuing new business as well, for pursuing anything new, it should be amply capitalized. Because every business has to grow. So for that, capital is required. Thirdly, can I say regulatory? Any other reasons as to why a bank may need capital? I think more or less this should be fine. So firstly, acting as a cushion or a safeguard, definitely. So a bank which is well capitalized will always find it easier to tide over any kind of financial crisis. So those banks who were well capitalized, even during the meltdown, found it comparatively easy to survive. So people like JPM, etc., they were well funded, so they did not have problems. But others, they had to rush for some kind of a rescue. Either they went to the Federal Reserve, or they merged with larger banks. So those banks who have a robust capital framework have that kind of a safeguard or a cushion to protect them against any kind of economic shocks. Then capital is also required for pursuing new business opportunities, because any business, if it has to grow, it will require capital. So yes, the main idea generation, etc., all is important. But for actual implementation of those ideas into practice, we require capital. So those banks who have a robust capital framework and who can afford to pursue new business opportunities will always find their uh, revenue lines improving. Third is regulatory. So every bank needs to satisfy regulatory requirements. So regulator expects banks to park certain amount of money, which we call as the capital charge or capital requirements. Because the idea of regulator is, it's basically trying to explain banks that you should be well capitalized in such a way that even if there is a system stress, you should not come running to us for rescue all the time. That's simply not acceptable. So that's why a bank needs to have robust amount of capital. So that way, tier one, tier two capital, etc., all these things will be covered in Basel as well. So banks adhere to this, and they try to maintain a certain level of capital, which is generally above the threshold which the regulator prescribes. So these are a few reasons as to why a bank may require capital. Now, talking of a few specific things when we talk of the capital requirements for a bank, one can be a CVA, or a credit value adjustment. So have you heard of CVA before? So maybe I'll just switch to the whiteboard and I'll write the things there. Was CVA discussed as a part of anything prior to this? Or have you read about it anywhere?
No, sir.
Okay, okay. So the idea of CVA is to account for your counterparty credit risk, because as a part of your trading portfolio, you will be transacting with multiple counterparties. Most of them are going to be non-government in nature. That is, they could be private institutions, they could either be banks or corporates or other financial institutions. But finally, all of them are private bodies, or they are basically non-government in nature. So there is always a risk which is associated with them, isn't it? Because whenever you are transacting with someone who is a non-government entity, there is always a potential risk of default. There is no certainty, but there is always a potential that they may default at a certain point in time. And this is generally studied from the point of view of your credit ratings. Because, so we'll talk a bit about credit ratings in our subsequent sessions. But the idea of credit ratings is that it helps you gauge what is the credit standing for a certain entity. So generally, a higher credit rating implies that someone is comparatively safer from a credit perspective. But someone who has a poorer credit rating, that basically implies that the chances of them defaulting is comparatively higher. So we have something called as an investment grade and junk grade. So what is that cutoff which separates investment grade versus junk grade bonds? Anyone? So we start with AAA, but up till what level do I need to go to classify them as investment grade?
B.
Actually, triple B.
So, but India's current classification is triple B. So that means we are just on threshold.
Yes, yes. So I mean, these sovereign ratings keep on changing. So that way, at the moment, fine. I mean, but the world knows that India is a good economy, so I don't think that will be much of a problem. But I mean, these things keep on getting updated. So rating agencies also follow certain models, and they generally look at what the overall economic environment is, etc. So that way, these things keep on fluctuating. Now, anything below triple B is what we call as a high yield or a junk grade bond. Junk grade or non-investment grade. So anything below triple B. So most banks you'll see they will try to hold something in the investment grade side because banks are that way inherently risk averse. They don't want to take on unnecessary risk, and if they are transacting or holding securities which are rated below triple B, they are naturally adding more credit risk on their books, which they would not want to add. Many a times, a bank may have a certain organization-wide policy which will restrict them from holding or trading any kind of below investment grade debt. So your policy could say that you can transact anything up till triple B. Below that, we won't allow you to trade. So if that is the condition, then you'll find banks holding only superior quality bonds, and that is generally what happens in a common marketplace. Banks always try to be conservative. Now, of course, now those banks who want to take on additional risk on their books and who may have an ample amount of capital which they have earmarked, then they may definitely want to go in for some kind of high yield bond trading as well. But in India, that proportion is far lesser. Maybe in the developed markets where you have a well-developed high-yield market or a junk-grade bond market, that way the proportion may be higher there. But the idea is credit ratings give you a decent idea as to what is the credit risk which is embedded for a certain counterparty. That is, let's say I have two counterparties, ABC and maybe XYZ. So ABC could be rated AAA, whereas XYZ could be rated, let's say, B. So this basically implies that ABC is far more credit worthy because they're having a very strong credit rating. So the chances of them potentially defaulting are low. But for XYZ, they're holding a weak credit rating. They're holding a B rating, which is not very robust. So there is a chance that they may default. So if I had to look at it from a counterparty credit exposure or counterparty credit risk perspective, then I would always prefer ABC over XYZ. Now, that doesn't mean that I won't have to transact with XYZ. Now, imagine that my organization policy doesn't restrict me and I have the freedom to transact with anyone. Then in that case, yes, I may want to transact with XYZ because the business opportunity may be really good. So that way, if the opportunity is good, I can have some additional safeguards and I can still pursue that opportunity. Now, this accounting for counterparty credit risk or change in the credit risk for a counterparty is something which we try to understand through CVA, which stands for credit value adjustment.
Sir, I had a doubt.
Yes.
So who exactly decides who gets what rating?
So these are generally your external credit rating agencies. So most banks are going to use these leading credit raters like CRISIL, ICRA, CARE, etc. And they use those ratings for their consumption.
Sir, because in that movie, The Big Short, it is very clearly shown that how system is rigged.
Correct. So there were problems back in 2008. So I'm not saying they are not there now. There can be problems now as well. So there was a basically conflict of interest for many of these credit rating agencies. And at times there were instances whereby there was collusion between the management of the firm and the credit rating agency. Of course, now they had to face legal and regulatory action against that. But after that, even regulatory agencies have put in additional checks and balances so as to ensure that such collusion doesn't happen and the conflict of interests are completely managed. Because finally, independence and objectivity of rating firms is immensely important. If they start colluding with their business or with their clients who are basically giving them business, that basically defeats the purpose of credit rating. But uh, but post the financial debacle, things have gradually been improved, I would say. So more and more robust frameworks are coming into place so that such conflicts of interest get managed. But you are right. I mean, there were problems in the past. I'm not saying the problems might have vanished now. Problems can still be there, but they are addressed to a considerable extent.
Sir, because as recently as 2015, there were allegations that Saudis were influencing Moody's to give them a better rating.
So
And
now again,
Saudi is basically a family disguised as a country, basically. Family enterprise disguised as a country.
correct. Now, I mean, yes, these kind of things can always come up unless they are proven right. It's very hard to say whether it's really correct or wrong. But yes, I mean, there are always certain geopolitical influences, or even globally, there may be certain pressures which credit rating agencies might have to face. But in spite of that, they can have certain policies which can restrict any kind of unlawful behavior, or maybe something which doesn't really reflect well on their independence part. So that is something which rating agencies are trying to address in the best way possible. So that's why we tend to use these rating agencies' data in our analysis. And the advantage is rating agencies are specialists when it comes to allocation of credit rating. So banks would always want to use their expertise in order to use the credit rating for their purposes. Because honestly, credit rating is a completely different skill set altogether. Now, if bank decide, now yes, a bank, if they want, they can definitely hire credit analysts who can do the complete analysis for them. But that may not be possible all the time because the bank may be having so many customers that maybe doing a complete credit review as comprehensive as a credit rating agency might not be possible, because that way their profitability might take a hit, or simply it may not fit in with their business. Because finally, a bank's core business isn't credit rating, isn't it? The main business is borrowing and lending of money. So for that, whatever is required, they will use. So that's why, I mean, rating agencies' data is something which banks readily consume. So as a part of CVA, we try to address what you call as a credit transition risk. So when I say a credit transition risk, that's basically the risk of transition of your credit ratings. So through the CVA capital charge, what we try to understand is if some party who was rated triple A, something like ABC, if they drop to, let's say, A, then what is the impact on my capital adequacy? Because naturally, if the rating of my counterparty drops, I will have to allocate more capital, isn't it? Because a downgrade in my counterparty rating exposes me to potentially higher credit risk. I say potentially high. It may not mean that they will definitely default. But for me, I need to take the required provisions. So for that, if I see a downgrade in the credit rating, that is, if I see a credit transition happening, I should allocate some additional capital, which is proportionate to this drop in rating. And how much is the proportionate capital? That is something which we try to address through a concept of risk weights. We'll talk about that in a bit. But this is the idea of CVA. We are trying to address credit transition risk of counterparties, and we are trying to make sure that we have ample amount of capital provisioning done in the face of any kind of downgrades or upgrades which are happening for credit ratings of my counterparties. So is the idea of CVA charge clear? Any questions on this?
So just one question. So I understand that they need to allocate more capital if there is a if there's a downgrade or something. But what do banks do when their assets turn into junk? Like, do they sell them, or do they still hold on to them?
So if they can find a buyer who is willing to purchase them, then they'll definitely want to offload them. If not, they'll be stuck with that asset.
Okay, but because then, sir, if because if they decide to hold on to it, they would be locking up some capital as well, right? So, like, what is the sane thing to do? Is it to sell it off? Is it to keep it?
So again, it depends on your active market. If there's no one there to purchase those assets, then the bank will have to hold it on to those products. So maybe a junk bond they may have to hold on to. So that way, I mean, unless you find someone to offload that product, it will be difficult to sell. So that way, that's why I say banks are very careful whenever they are going in for investments, and that's why they have a very robust criteria which says that let's stick to investment grade, let's not go below. So even if it drops slightly below triple B, they're still well above the junk grade level. So I mean, when I say well above, at least they're on something like maybe a double B, which is still manageable. Now comparing double B versus something which is C, now double B is always preferable. So that's why what banks say is let's stick to triple B. Worst case scenario, even if triple B drops to double B, then offloading a double B security would be comparatively easy rather than holding on something which is a C rated one. So that way, maybe a dropping credit rating might prompt traders to sell off certain securities as well, with the fear that if the ratings drop further, it may be difficult to offload those securities at a later point in time.
Okay, so one more question. Now, I had previously, so we had previously seen the default rates on these bonds. Okay, so for something like AAA, I think it's around 97 or 98%. I think, if I'm not wrong, and then it
Uh,
keeps on going down, like for your AA, for your A, and so on.
mhm.
So I imagine AAA, of course, like they would be offering the lowest rates. Double B would be slightly higher, marginally higher, and so on. Correct?
Yes, the yields are comparatively higher. Yes.
Okay. So now, sir, isn't it is it worth it for the bank to hold the AAA, or can they settle for a double A if they feel that because 98 to 97% rate of default is very less comparatively. But if the interest rate is worth the risk, then why not, right?
So yes, now if the bank feels that they can take on that additional risk, then definitely. But there are a few things which need to be taken into consideration. First is, are they willing to allocate some additional capital for taking on a lower rated bond? So first is capital.
Okay.
Second is, does it fit in their organization policy? So does the policy say that you can have so many number of bonds which are rated double A or below? That could be another. Third could be they could also be concerned now, especially when we talk of such lower rated bonds, we are talking of non-SLR securities. So is there active market for lower rated bonds? Because just like my bank, other banks might have a thought process that someone who is AAA, we want to hold them. But maybe someone who is A rated, although the yield is high, my risk appetite prevents me from going there. So if there is no active market, then there's no point in holding on to those securities. Anything else? So maybe they may have to do some kind of a illiquidity provisioning as well. So we'll talk a bit about illiquidity provisioning in this discussion. But they may have to make a capital provision for illiquidity. So lower rated my bonds, the lesser active will be the market generally. And in that case, I'll need to push my liquidity reserves up because I need to tackle that shock of illiquidity which I can potentially be exposed to. So I would say it will be a very business specific decision for a bank as to whether they're fine with chasing a higher yield or might as well agree to a slightly lower yield but still stay on the safer side.
Okay, and sir, last question. Uh, in the Indian scenario, for the Indian market in general, what is the average rating that goes on in the market? Are Indian companies able to maintain a AAA rating, or are they hovering between A, AA, or something like that?
So I won't say everyone is AAA, but everyone tries to stay in the investment grade because even companies know that many a times fund managers or even investment management firms have a restriction. So they would say that fund managers can only park their money up to investment grade. Anything below triple B, they don't want to park their money in. So companies will also strive hard to ensure that they remain in the investment grade. So that way they may have different business policies or processes such that their business continues to do well and they continue to abide by all of their commitments. So the target would be to stay in the investment grade, but and if things go wrong, I mean, someone can definitely drop in the non-investment grade category. But whenever that happens, every company would always want to improve and basically move up the ladder. So target will be investment grade or close to investment grade, I would say.
So then, sir, in terms of attractiveness to foreign investors, Indian bonds, I would imagine they are not so attractive because they carry a lot of risk comparatively, right?
So again, high-rated corporate bonds is not, or high-rated bonds is not much of a problem because if you take a government security or maybe someone stable like a HDFC Limited, HDFC Bank, so
Mhm.
those kind of bonds are always acceptable to investors because they know that these are robust entities because they also know the Indian scenario and they know that these are good companies. So that way, higher rated bonds will always be successful in attracting more capital. There may be very few specific foreign investors who specifically want high yield debt. But if that is the case, they would target high yield debt in their respective countries, right? Why do they want additional country risk exposure by investing in India?
Exactly, sir.
So
Because exactly, sir. Because it's not common for you to hear that. Because it's not common for you to hear that an Indian firm has raised money from abroad. Barring a few very very large corporations, it's very rare to hear that.
exactly. So, and that's the precise reason. Now, why take on additional country risk if you're just interested in investment grade or maybe below investment grade, that we what we call the high yield bonds, and let's say it's a European bank, then those traders will say we might as well tap the European market. Why should we tap the market in India and unnecessarily expose ourselves to FX risk as well as country risk? So,
Okay, sir.
generally,
Got it.
attractiveness for investment grade is better from foreign investors' perspective.
Okay, sir. Got it.
All right. So we're at 17:40. So basically 5:40. So let's take a quick break for 5 minutes and then come back and then we'll see the approach for CVA. Yeah. So a quick 5 minute tea break and then we'll continue. Can we resume?
Yes, sir.
Okay. So the idea is the CVA charge which we calculate, that is always computed at an enterprise-wide level. So your CVA capital charge will be at a bank-wide level. Because finally, since it's a part of your capital adequacy, the capital adequacy of the entire bank is something which we are interested in. So this will be calculated at an enterprise level. But just to give you an idea as to how a CVA charge gets calculated, we can start from the basic portfolio level position, and then we can go a step up till we reach the final bank-wide level. So I'll give you the flow, the details of the capital charge calculation and formulas, etc., that are there in the Basel circular. So we'll not get into the formulas as such, but we'll try to understand the approach which is being followed. So as a very first thing, I start with my trade-wise numbers. So imagine that I have access to my trading portfolio, and again, that is something which is available in my system on a day-to-day basis. So every day I have the portfolio which gets updated, because my traders will keep on transacting, and that way I'll have new positions which are being added to my trading book. So imagine that I have 5 transactions, or maybe let's say I have 4 transactions. And let's say one is with bank A, then I have someone, or maybe let's give names. Let's say I have this with Axis. Let's say I have this with ICICI. Let's say I have this again with HDFC, and third one, and maybe the fourth one is again with HDFC. So let's say I have 4 transactions. So imagine this is my trading book. Let's take a very small trading book. Let's say I've just started out my business, and this is my trading portfolio. So as a bank, I just have 4 derivatives on my book. And maybe this could be a swap. Maybe this could be a cross-currency swap. And this could be a forward contract. Maybe this is an FX option, etc. And I have all of the relevant information after this. That is, I have my MTMs. I have my PFEs, etc. Now, how do you calculate PFE, etc.? We'll see in our subsequent sessions when we talk of exposure monitoring. But for now, imagine that I have my MTMs and PFEs which are there. So PFE stands for potential future exposure. So there are certain approaches to do that. So we'll, in a subsequent session, we'll see how a PFE gets calculated as well when we talk of exposure monitoring for clients. So let's say this entire table is filled. That is, for all of these 4 trades, I have all of the required information. Now, this is like a trade-wise information. I have simply taken a trade-wise dump from my system, and I have just used it here. Finally, my aim is to go to the bank level. That is, I need to take into consideration all of my counterparties. I have to collate the trades accordingly, because for every counterparty, I may have to apply a risk weight. And as I mentioned, risk weight is something which will be dependent on your credit ratings. So now, since I have multiple trades with different counterparties, I need to ensure that I have one single line item for every counterparty, because that will make application of that risk weight easy, isn't it? Because I have 2 trades with HDFC here. Now, as a next step, what I can do is I can collate the trades across counterparties. So collate trades across respective counterparties. That is, after I collate this, I'll have Axis, I'll have ICICI, and I'll have only one HDFC, because I have combined the 2 transactions which I have with HDFC. Because finally, I want to calculate my credit transition risk to HDFC group, isn't it? I don't want it trade-wise, but I want it on a collated number, or I want to have it on a level of the enterprise, which is HDFC Limited or HDFC Bank, whichever you say. So that way, the next step is collation of trades across counterparties. So if I have, let's say, 100 trades with Axis, I'm going to combine all of those 100 trades into one, and I have one single line item for Axis. So that is basically taking me a step ahead, isn't it? Because I start from a trade-wise number. So when I say trade-wise, I'll have information for every single transaction with my counterparty. Then I go to counterparty level. So trade-wise level becomes counterparty-wise or counterparty-wide level. Now, again, I may have some collateral which has been pledged. So what would be the idea of factoring in collateral? Now, how exactly does collateral help me? And firstly, what is collateral? So when I say collateral, what comes to your mind?
Sir, it's some sort of asset that has been deposited or been deposited in your custody,
Mhm.
as like and it acts as a safeguard in case of a default of your
Correct.
lender or something.
Correct. Correct. So basically, this is nothing but your cash or cash-like products which you generally pledge. So the idea is, if your counterparty defaults, then you have this collateral which you can basically use to make good your potential losses. So as a part of the transactions, always, I mean, collateral generally gets exchanged as well, because idea of having collateral is to reduce your counterparty credit exposure. So tomorrow, if your counterparty is default, then you should have something to fall back upon. So that is where collateral gets used as well. So I may have my net exposure, I may have my firstly gross exposure. So you can say this is my gross exposure, the first statement. Because if you see in this, I have not factored in collateral yet. There was no mention of collateral. Maybe at this step, I can factor in collateral, because I may have collateral numbers which I have received from, let's say, Axis, HDFC, ICICI, etc. So whatever my total exposure is, and my exposure is nothing but MTM plus PFE. So whatever my exposure to my counterparty is, I adjust it for collateral. So if I have X, Y, and Z as my exposures to respective counterparties, and if I have certain collaterals which are given as C1, C2, and C3, let's say these three counterparties have parked C1 through to C3 with me. That is, I hold this cash collateral which they have given me. So my exposure to them reduces. So my exposure to them will be X minus C1, Y minus C2, Z minus C3, etc. And this is what I can call as my net exposure. Now, why we do this? Because as I mentioned, once I have collateral in the form of a certain asset, I can liquidate that asset if my counterparty defaults. And that is something which will help me manage my exposure. So that collateral has to be factored in. So that's why I say that this is the net adjustment which I have to do. Any collateral which I hold, I simply subtract it from my numbers, so that when I calculate my capital charge on the CVA, I need to factor in this drop. Otherwise, it will mean that I'm double counting things. I already have collateral, but at the same time, I'm still holding higher CVA charge, which is not expected, right? Because I already have collateral. So why should I have something more? And why not factor in the collateral? So that's why I have to adjust for this collateral before I take a step ahead. So this is what I call as the netting of your exposures. So I have my gross exposure first. After that, based on how much the counterparty has pledged me, I'm going to make the collateral adjustment. So that way I have a net exposure number which I get used. Once this is done, I have to look at credit ratings. So why credit ratings are important, we have already seen when we spoke of the introduction to CVA. So credit ratings basically tell me how much is the transition risk which I'm holding on my book. So let's say Axis was rated AAA last week. Now let's say Axis has dropped to maybe a AA rating. So this drop in credit rating is something which I call as a credit transition risk, because the credit risk of Axis has transitioned, isn't it? Earlier it was very safe, it was AAA, but that has, I mean, they have moved away from AAA. They have become slightly more riskier because they are dropped on the rating scale. So they have become AA now. So this drop is something which is going to push up my requirement for capital for Axis. So the more transactions I do with Axis, more will be my capital requirement for my transactions with Axis because of this drop in ratings. And this is something which we call as a credit transition risk, which we try to address through the CVA charge. So as a next step, what I do is I have access to my credit rating scale. So if I show you the next report, it could be something like this. So let's drop the formulas, etc. But at least the idea is something which is more important. So we'll have our counterparties here. So Axis, ICICI, HDFC. And I have my exposure numbers. I would have the rating data. Based on this, I could have my risk weights. Then there are Basel specific calculations, which you can check out later on. So Basel calculations. So let me just erase this portion. Basel calculations. And based on these calculations, I get what I call as a CVA number. Basically, my output. So the idea is once I have adjusted for my exposures and I have taken into consideration the ratings of my counterparty. So depending on the ratings, there'll be a certain risk weight which is allocated. So someone who is rated triple A, so let's say this is triple A, let's say this is double A, then maybe the risk weight applied could be 0.1% for this. Maybe the risk weight applied here could be, let's say, 0.3%, and so on. Now, the exact numbers, again, you'll get to see in the Basel guideline. I'm just putting hypothetical values here. But the idea is the more riskier the entity, the higher would be the risk weight, naturally, because you're trying to factor in the potential credit risk in that entity. So that is something which is going to have an impact on your overall CVA charge number. I do this across counterparties. So again, it's a standard formula which I use. Nothing very difficult as such. It's a regulatory driven thing. And after that, I come to a number which I call as the CVA capital charge. And this CVA capital charge is something which needs to be calculated on a daily basis, because I need to know what is the potential credit risk which I am holding, because I have transactions with so many counterparties. And whenever there is a change in the rating for the counterparty, I may have to revise my ratings scale, because that ratings data has to be updated so that the impact of this change in rating gets used. Now, again, ratings are something which don't change every day. So what banks will generally do is they will do this exercise once every couple of months. So maybe let's say they do it at the start of January, then they may want to do it in, let's say, around mid-March or maybe end of February, because credit ratings will not change daily. They will change only periodically. Of course, that being said, if there is a sudden negative news about a certain company, if their rating suddenly drops, then that is something which the bank will automatically catch as well. So that is something which will get impacted in, or that will get reflected in their calculations. But otherwise, in a business as usual scenario, when you don't see a drastic change in ratings, uh, banks also hold these ratings for some time, and maybe every couple of months they will revise their ratings, and that way they keep on calculating their CVA charge. But this number has to be computed on a daily basis. It's a regulatory requirement. So most of the banks will have a ready system which will calculate the CVA capital charge at an enterprise-wide level, and that can be reported to the regulator as well as to your management. So is the idea okay? Any questions?
Just one question. When you said that this collateral can be exchanged, so technically it's a deposit of somebody else that you like no. So it's just a deposit that's been kept with you. So how can you
Uh,
exchange it?
so not exactly a deposit as such. Now, collateral is something which will keep on exchange between me and my counterparty. So that is basically related to an idea called as a CSA, which we call as a credit support annex. So we'll talk about CSA when we talk of exposure monitoring. So at that time, this CSA management will be, I mean, that will be more easy to understand. But for now, imagine that this is like a cash collateral which gets exchanged between counterparties. So today, let's say I'm in the money, then I'll be receiving a collateral from my counterparty. Tomorrow, let's say my counterparty is in the money based on the valuation of the portfolio, because market conditions can change. I can have more transactions with the counterparty, etc. And if that results in my counterparty being in the money that day, then it is me who has to transfer collateral to them. And that's why we say this is like a collateral exchange. It happens on a day-to-day basis based on the valuation of your portfolio.
Okay, sir. I'll read more on this then.
Yeah, now, anyways, we'll talk about CSA as well later on when we talk of exposure monitoring.
Okay, sure, sir.
So this is one. Now let me see if there are any points related to CVA. So CVA charge calculation. Also, now a thing on a certain exclusions which come as a part of the CVA. So not every position which you're holding on your trading book will require CVA capital charge. Now there are certain trades which are excluded from your requirement for CVA capital charge. So a few of these can be. So maybe I'll just use this space. So a few exclusions which you will generally observe. That is, these are the things which do not attract a CVA capital charge. One can be sold options. So sold option positions will not attract any capital charge, because if I have sold the option to someone, let's say I have sold the FX option to a counterparty, then I have already received the premium for that. So tomorrow, if I default, the counterparty is going to lose something. I already have the money with me. But so therefore, for a sold option, I don't hold any kind of a CVA capital charge. But if I'm holding an option, that is, if I'm purchaser or if I'm buyer of option, then yes, it's definitely a problem for me, because if my counterparty defaults tomorrow, then I'm exposed to a potential credit risk. So any options which I have purchased will require a CVA capital charge, but if I have sold any options, those will not be there. Those will not attract the CVA charge. Next is any exchange traded contracts. So any kind of IRFs so interest rate futures, which we transact on exchanges, or maybe any kind of other exchange traded derivatives. Now, for this, I don't have to separately allocate a CVA capital charge, because exchange is something which we classify as a CCP, or a central counterparty. And you know that whenever there is a CCP, so something which we have discussed when we spoke of fixed income, whenever we have someone like a exchange who is acting as a CCP, they are going to guarantee the clearing and settlement of transactions. That is, they are going to ensure that no matter what, my clearing and settlement of the trades will happen smoothly. In other words, they are telling me that the credit risk has been taken care of. This is also what we call as a centrally cleared trade. So anything which trades on the exchange, or these things like IRFs or maybe index options, etc., I don't have to worry about them. I do not allocate capital charge there. Third can be those which are backed by any other CCP, something like maybe a CCIL in India. So in CCIL backs certain swap transactions, or maybe certain forward transactions. So those transactions which are backed by someone like a CCIL, because CCIL is again a CCP, isn't it? Now, exchange has a clearinghouse. Similarly, even CCIL has a clearinghouse. So if there is a certain swap transaction which is backed by CCIL, that is, if I have traded that on a CCIL platform, that basically implies that CCIL has taken the onus on itself to ensure that the clearing and settlement of my swap transaction will happen without any problems of default. So again, in that scenario, I do not have to allocate any kind of CVA capital charge there. Any other exclusions? I think certain FX forward trades, and I think if I recollect, the tenor was 14 days. So any FX trades with a maturity less than 14 days also gets excluded. I think this was one of the guidelines. I'll also have to check this once. Also, one more exclusion which can happen is many times your bank might want to transact with a certain entity which is in a geopolitically risky area. So let's say let's say my trader in the front office wishes to transact with a certain bank in Iran. Now, Iran is generally a very politically sensitive country. So that way, the bank would have a policy for treating those clients separately. So they may have a separate guideline in case you have to transact with someone in a high risk country, someone like Iran or maybe an Iraq. So at that time, what can happen is, let's say I want to enter into a FX forward transaction with them. Now, generally, we keep the tenor to be short for such transactions. So if the transaction tenor is shorter, what I do is, let's say we are going in for a USD INR FX forward. So what I tell my counterparty in Iran is, you have to park your collateral in a Nostro account. So before that, I am not going to transact with you at all, because the idea is they are comparatively risky countries to transact. So the idea is we ask them to allocate sufficient amount of collateral in a Nostro account. So during the life of the trade, if something goes wrong, if at maturity the Iranian bank says that we cannot service our side of the transaction, then we always have a collateral to fall back upon, and that collateral is pretty hefty. So that way, if it's a USD INR or maybe if it's a Euro USD transaction, and if we are swapping one of the currencies, we can tell them that the entire notional which is going to be swapped, we want you to park that notional in a Nostro account. So tomorrow, if you guys default, then we can simply approach that Nostro account and we can make up our losses. So that is how banks would want to transact with certain politically or geopolitically sensitive entities. And again, for these kind of transactions, you may not have to do a CVA capital charge allocation, because the thing is you're taking entire amount of notional which will be exchanged as collateral. Now, naturally, you don't have that in possession now, but that is parked with a third party bank, which can be someone like maybe a JP Morgan Hong Kong. So an Iranian bank could have a Nostro account in JPM Hong Kong, and they will park the entire USD chunk there. So if something goes wrong, JPM Hong Kong will pay me, so that I don't have to face any kind of losses. Now, again, this is like a risk-free transaction, isn't it? Even if my counterparty defaults, I'm not exposed to anything. That way, I mean, these kind of transactions are also something for which you need not have to calculate a CVA capital charge. So now these are like exclusions which you'll get to see as a part of your circular, but I have mentioned the ones which are generally observed. But other than this, I'm sure there will be a few more exclusions which are permitted as a part of the regulatory guidelines. So something which you can definitely check in the Basel circular, and which will give you additional insights into this as well. So any questions?
Sir,
No,
is
sir,
it
nothing.
covered under Basel III norms now, CVA and all?
Yes, yes.
Okay, so
So it will be there in the Basel III circular. Yes. Either in Basel III, or you'll find a related circular to Basel III. But this is definitely a part of the Basel guideline. So if not in the Basel III circular as such, you'll definitely find it in the related circular. So that will definitely be there.
sir, but won't it be under the jurisdiction of RBI?
So RBI's idea is to issue guidelines and ensure that banks are adhering to the guidelines. Now, how exactly to calculate the CVA charge and also manage their exposure, that is the onus of the banks, not the regulator. So it's basically just like a driving license thing. Now, once a person receives a driving license, the entity, now it's that person's responsibility to ensure that he or she drives the vehicle correctly without knocking people down or maybe banging that vehicle against some obstruction. Now, the RTO authority is simply issuing them a license, so it's under their jurisdiction. But to use it judiciously, that is something which is the responsibility of that individual. So loosely, you can also apply this to a banking parallels. RBI has issued them banking licenses, and RBI has given a guidelines. So just like the traffic authority tells us the do's and don'ts for a vehicle, so something similar will be given by RBI as well, which we call as the RBI guideline. Now, how exactly the guideline is to be followed, that is the onus of a respective bank. So is that okay? Any further questions? Oh. So I can next one, which is capital charge. We still have time, right? Yeah, 6:12. So let me see if there is a smaller. So the next sub point is slightly bigger, capital charge thing. I'll see something which is shorter, and then maybe we can, because we still have like 10 minutes, but let me see if something which can be covered now. One illiquidity adjustment. Okay. So capital charge is something which is the next point, but it will take some time. So the market risk capital charge is something which we'll cover in the next class. But now we have like 10 minutes. So maybe I can generally give you an idea of illiquidity provisioning, which banks do. So the idea of illiquidity provisioning is to basically try to answer the question that if I have to offload a certain illiquid security tomorrow, then how much is the cost that I'm willing to bear? That is, let's say if I have a certain non-SLR security, which has a rating of maybe triple B. It's not a very highly rated entity. So tomorrow, if I have to offload this security, then how much is the potential cost for me? Because not every non-SLR is liquid enough. And someone who is rated triple B or maybe even B for that matter. Now, these lower rated securities may even have a lower market liquidity. So for that, if I have to offload this bond tomorrow, it will cost me, because I may have a certain target price in mind, but the market may say that we won't really pay you that much. We can pay you only an X amount, take it or leave it. So that is what we call as a price which I'm willing to pay. So let's say as per my bond, as per my model, a certain bond which is illiquid is worth maybe 80 rupees on a face value of 100. But when I go to the market may say that we feel it's just 70. We can't really pay you 80. So that is what I call as the illiquidity premium, which I need to factor in. And when I say illiquidity provisioning, I'm trying to answer that question. That is, if I have to offload my illiquid portfolio tomorrow, what is the cost that I'll be willing to pay? So that's the illiquidity provisioning bit. So to give an idea of a way in which this can be done. So again, the problem so if I talk of fixed income, now why talk of fixed income first? Because banks hold significant positions in fixed income investments for a variety of reasons. Now, not every bond which is held on the portfolio is liquid. Now, for SLRs is not much of a problem. So SLR securities are very, very liquid. So any kind of a government-backed security is immensely liquid. So there's not much of a problem of illiquidity there. You can easily offload those securities. But for non-SLR bonds, that can't be said all the time. You may have certain non-SLR bonds which are liquid and certain which aren't. So maybe some bond which is issued by probably an ICICI bank or maybe someone by Reliance. Now, those bonds could be liquidly traded, but as against that, imagine a certain lower rated entity who has also issued the bond. Now, those bonds may not be very liquid. That is, the market isn't very sure about them, so they are not transacting them very, very frequently. So it is for these kind of bonds that I need to adjust for illiquidity. Now, question might be, how do I decide if a certain bond is illiquid? So one easy approach to do that is to look at how frequently that bond has traded. So I have mentioned about FIMDA in one of our previous sessions. So Fixed Income and Money Market Dealers Association. So FIMDA on a daily basis publishes a report which gives you a list of all of the non-SLR securities which are transacted on that day, along with what was the volume, what was the price it was traded, maybe the high and low price, and also the closing price. And this is a report which gets generated every day in the evening. So I think around 7 p.m. this report is generated by FIMDA. So the banks can know that these are the securities which have transacted throughout the trading day, and this is the volume, etc. Now, one way to understand illiquidity is to keep track of last 15 days of FIMDA data. So let's say I have a certain bond. Let's say I have a certain bond X, which had transacted on, let's say, 1st of March. And the next trade happened only, or maybe it did not trade for the next 15 days. So starting from 1st March right until 15th of March, there was no transaction, nothing in between, just one trade here, and that was it. After that, market simply did not transact bond X. So in case a bond doesn't transact for the next 15 days, we can classify that bond as an illiquid security, because 15 days is a considerably long period for a bond to not trade. So whether this happens, we can say that this is a bond which is illiquid in nature. Now, as against the case, let's say if X is trading every day, that is, if transacted on the 1st of March, immediately on 3rd, 5th, 6th March, it has got transacted in the market. So that way we say that X is liquid in nature. But in this case, X is immensely illiquid because it did not trade in 15 days. So what a bank can say is this bond is illiquid, and we can classify this as an illiquid security. And every bank has a policy for how much is the quantum to be allocated for illiquidity. So that quantum could be based on your rating. So maybe bonds which are rated AAA up to A. This illiquidity provisioning could be maybe 25 basis points. 25 basis points of your market value. Anything below A, so something like triple B and below, your requirement could be, let's say, 50 basis. That is, I have to allocate 50 basis points of the market value of this security. That is, if MV is the market value of X, then if this falls in this category AAA to A, then the illiquidity will be this market value into 0.25 bips. or 0.25%. This will give me the provisioning amount. Similarly, if I have X which is a lower rated, or maybe I have a certain entity Y which is of lower rating, let's say it's rated B, then it falls in this bucket which attracts 50 bips. So here it will be market value of Y into 50 bips or 0.5%, and this will be market value of X. So this is one approach. Now, there is no uniform approach for adjusting for illiquidity. Every bank may follow a certain different approach. But this is one of the approaches which banks can follow in order to figure out what would be the estimated cost of illiquidity which they have to bear in mind. And this is a capital provisioning which a bank has to do on its books. So does the idea look okay? Okay. Now, similar treatment can be applied for your CPs or CDs as well. So again, commercial papers and certificates of deposits also are classified as fixed income securities. So again, you can apply a similar guideline there as well. So traded versus non-traded. That's mainly fixed income. Now for equities, now banks hold a very small portion in equities. Now in Indian banks are not very active on the equities front. They may participate in, let's say, one of the IPOs, but their holding is very, very short. They may just book their listing gains and they'll exit their position. But in case a bank does have some amount of equity positions, then those equities which transact on the exchange are naturally liquid. You don't have to do any kind of provisioning for that. However, certain securities which are illiquid, especially those securities which come through your CDR route or corporate debt restructuring, that is something for which you'll have to adjust for illiquidity, because something which comes through a CDR route, naturally that entity doesn't have equity which is very, very liquid enough. So you'll have to adjust for illiquidity, because is everyone aware of the idea of CDR or corporate debt restructuring?
So basically taking a haircut.
Okay, haircut is one, but anything else, something to do with maybe changing the terms and conditions for a certain loan as a part of the CDR process. So
Sir, I
what's
guess
that called?
it's called refinancing or something like that.
Something similar, yes.
Like
So
you can extend the tenure of the loan.
exactly. Exactly. So many times what happens is certain borrower who has taken money from the bank is unable to repay because maybe their business has run into some problems and they're unable to generate ample amount of cash to make the required payments to the bank. So at that time, a bank would do an assessment. So they would say they would have a discussion with the borrower and also understand their problems. And if the bank feels that that particular borrower is capable of paying going ahead, only thing is at the moment they're facing some funding pressure. So what a bank can propose is let's go in for so rather than classifying you as NPA, we can go in for a CDR or a corporate debt restructuring. So that way we can adjust our loan terms in such a way that you get a longer time to repay the loan. And in that return, you give us something, and that something is generally an equity of that particular business. So you may have, so that's how unlisted equities come on banks' books. So as a part of your CDR process, so once the CDR is sanctioned, that particular borrower may give you a portion of the equity of their business. Now these are illiquid because your borrower is not a listed entity. So for these kind of investments, you need to make a provisioning, because tomorrow if you go to offload this equity in the market, there won't be too many market players who would be interested in that, because this has come to you through a CDR route. Naturally, even you would not have purchased them directly, isn't it? So you can't really expect a very liquid market for that. So things which come in through the CDR route, this is also what we call as unlisted equities. Now these require illiquidity provisioning. So again, for this, you may have a certain policy which says that if you have a certain illiquid equity, then this much is the proportion of capital which needs to be allocated. So this we can do for equities. For derivatives, one way to do derivatives is to understand the bid-ask spread for based on the currency of your IRS. Now that is slightly complex, so we'll not get into that much. But there can definitely be a policy for derivatives also. But for fixed income and equities, this could be an approach. Again, I'm saying this could be an approach because every bank could have a different thought process. Some other bank may say that this may not suit us, so we want some other way of calculating provisions. So that way, some leeway is given. So banks can decide on their approach as to how exactly they want to factor in the illiquidities as a part of their statements. But this is something which banks are expected to do, and they have to justify to the regulator as well as to the approach which they are following. So that's why you require a policy for provisioning. So tomorrow, if regulator comes with a question, you can simply give them a copy of the policy saying that this is our approach. Does it sound okay?
Yes, sir.
All right, great. So we can stop at this point today. Now, we'll not talk about capital charge now because that will take and roughly about 20 minutes more, 20, 25 minutes. So that is something which we'll cover in the next class, and a few more things which are specific to the capital framework, something which we'll cover in our next session as well. So we'll talk a bit about liquidity also because that's also equally important. So that is something which we'll discuss as well. And I'll give you an idea of something on behavioral modeling. So that is something which you guys may have to do because many of you will be joining analytics teams. So in case you're joining analytics teams of a financial institution, they may require this behavioral modeling exercise to be done as well. So we'll talk a bit about that, something which ALM teams in banks do often. So before we depart, allow me to take your attendance. So do you guys have a session after this as well?
So we have one in 5:15.
No.
Yes, so we have one.
Oh, okay. All right. Akash Singh.
Yes, sir, present.
Okay. Achal Jain. Ayush Bhushan.
Present, sir.
Adya Shahati. Tejas.
Present, sir.
Adi is present. Anjali Garg. Arishmita Deka. Anmol Sen. Avni Mishra. Ayushi is present.
Yes, sir.
Sarvish. Bhavya Dang. Hari Chavra is present. Diksha Chauhan is present. Dipansha is present. Gaurav Kadam is present. Gaurav Datir. Himanshi Verma is present. Jaideep Saini is present. K. Ayushi.
Present, sir.
Priya Shukla.
Yes, she's present, sir.
Okay. Kriti Marwa is present. Mansi Singhal.
So she's also present.
Okay. Mansimran Arora.
Present, sir.
Manvi Kukreja is present. Mihir is present. Muskan Garg. Namrata Gaur. Neil is present. Nikhil Agarwal is present. Prasul Sharma. Pratik Maheshwar.
Present, sir.
Rachit Tyagi. Rahul Ghosh.
Yes, sir.
Rahul Giri. Rahul Goswami. Rajaditya is present. Rashi Jain is present. Rishabh Kothari.
Present, sir.
Ruma Keshri. Sahaj Manocha. Sameksha Chopra.
Present, sir. Sir, Avni is also present. Avni Mishra.
Okay.
Thank you, sir.
Avni Mishra is present. Okay. Akshay is present. Sharanya is present. Shubham Jain.
Yes, sir.
Shubham Kumar. Someshwar Verma. Stuti Mehrotra. Anika Thakur is present. Vinay Pawar. So FE guys, we are done. You guys can leave if you have a class after this, and I'll see you guys on Monday. So we won't have a class on Saturday. And now coming to IB. So Ayush Sharma is present. So I'll read out the names. If those are present, you can say present. Alisha Gupta, Vidhi, Anant Jain, Anish Topeshwarkar, Anjali Sethi is present. Arshada Imam is present. Barkha Israni, Bhavya Patel, Saloni, Chaitra Tirodkar. Devam Pandey is present. Diksha Kalra, Gauraja is present. Gayatri Mittal, Sawan is present. Himanshi Virmani is present. Indu, Ishita Saxena, Kanika Goyal, Karthik Mittal, Asro L. Laksha is present.
Present, sir.
Okay, she is present. Mahi Rajawat, Mansi Gupta, Matangi Warrior, Megha Parak, Nancy Anawat, Neha Jain, Pratishtha Pradhan, Rohan Bagai, Rohit Potar. If any of you is present, please let me know. Others, I'm marking them as absent. Samita Malik, Shivangi Semwal, Simran is present. Srishti Verma, Tanu Goyal, Tarang Kadyan, Kalyani Todkari, Twinkle Karnawat, Vaishnavi, Vanishka Jain, Vibhor, Vidu Shirana is present. Yash Mehra is absent. Okay. All right. So thank you very much. Thanks for joining in, and I look forward to meeting you on Monday. Okay. Arshada and Anjali are also present. All right. I'll mark them as present. So they are
Just
from
one last
IB,
thing.
right?
So what's the syllabus for the upcoming CUTE?
Oh yeah. So let me email it by tomorrow. Actually, I also haven't thought about what the format is, etc. So I'll talk to Shrikant sir also, and I'll let you guys know by Saturday. So actually
Okay,
tomorrow
sure.
I'm traveling. So but on Saturday I'll definitely let you guys know.
Okay, sure.
Yeah.
Thank you so much.
Thank you. Thank you.
Thank you, sir.
Thank you, sir.
Thank you. Thank you.